Should you pay down your mortgage or should you invest? Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down this timeless question. The Bank of Canada just increased interest rates by another 0.25%. This is the highest interest rate we've seen in 22 years. So now, more than ever, Canadians need to decide what's the best way to handle their money and their debt. From a purely financial perspective, it boils down to this question. Can the rate of return on your investment beat the interest rate on your loan? A few years ago, it was an easy question. If you had a fixed interest rate of 3% and investments earning you 10%, that's a no-brainer. Invest and keep the difference. But now, if the interest on your mortgage is 6% and investments only earn you 8%, not so easy. A 6% sure thing is likely better than an 8% maybe. This is an important point to understand. Whenever you have a loan, either a mortgage, student loan, or credit card debt, that interest rate is working against you. So if you can pay down that debt faster, you are getting a guaranteed rate of return equal to the interest rate. Investing is never guaranteed. Whether it's stocks, bonds, or real estate, there is always an element of risk and uncertainty. But paying down a debt, that is guaranteed. That's why I always say, don't even consider putting money into investments if you have credit card debt. In my video on the 4 steps to build wealth, paying off your credit card and other high interest debt is literally the very first step. Most credit cards charge you 20% interest if you don't pay your monthly balance. That's huge, so pay it off right away. There is no investment out there that can beat a guaranteed 20% rate of return. But mortgages are a different story. They charge much lower interest rates because they are secured loans. They're backed by the house itself. If you don't pay them back, the bank takes your house. They have collateral, so it's far less risky for the bank. That's why mortgages come with lower interest rates than other loans. Here's the bottom line. If you have any loan with interest above 10%, pay it off. It's unlikely for the stock market to earn you more than 10% in a year. So you're better off paying down that debt with your extra cash. But if you have a mortgage with interest around 6%, then investing may actually be the better choice. There are a lot of factors to consider, and that's what this video is about. As always, I include timestamps for each chapter, so feel free to skip ahead. So, can investing beat 6% interest? Historically speaking, yes. If we look at the US stock market over the past 100 years, we can expect an average rate of return between 8 and 10% every year, depending how you measure it. Again, this is never guaranteed. Some years you'll earn far more, some years you'll earn less, and some years the market will lose money. Look at this graph here. There's only been a few times when the yearly return lands on the average value of 10%. We see some big red losses, like 37% in 2008 when the housing market crashed. But we see a lot more big wins of 30% or higher. So if you take the average over the long term, you can expect a profit of 10% a year. Just don't expect a fixed return every year. The stock market is not like a GIC or a savings account. Some years you may gain 30%. Some years you may lose 10%. So if you can handle that volatility and remain focused on the long term, then investing may be right for you. If you zoom out, the stock market has an overall upward trend. And in the long run, even major crashes like 2008 or 2020 are just small dips that always recover. On that note, we're in the middle of a market downturn right now, especially in the Canadian market. Banks, telecoms, and real estate, which dominate the Canadian market, are all down right now. I look at this as an opportunity to buy these quality stocks at a discount. And when they eventually do recover, I expect to earn significant capital gains, far more than the 10% average. Continuing to invest during rough times can be a huge wealth builder, as I've discussed in these past videos. It's not easy, it takes discipline, but if you can weather the storm for a year or two, you might be rewarded with significant profits. Markets have always recovered, and that's where a lot of money can be made. That's what I'm banking on, but instead, if you pay down your mortgage, you lose out on that opportunity. Sure, you lock in a 6% rate of return, but you don't get to benefit from the recovery. And that's another important point. When you pay down your mortgage, that money is locked in. You can't change your mind. Once you give your money to the bank, you can't get it back. Technically, yes, you could refinance or apply for a HELOC to access that money, But those new loans will charge a higher interest rate than your original mortgage. The way I see it, investing in the stock market gives you more flexibility. I've said this many times. I never put money into stocks unless I will hold them for at least 3 years because the market can be unpredictable in the short term. But if I absolutely needed the money, I could always choose to sell my stocks at a moment's notice. If you pay down your mortgage instead, you don't get that choice. So make sure you plan ahead. On paper, if your investments can beat the interest rate on your loan, then investing is the way to go. But there are more factors to consider. Don't underestimate the psychological impact that debt can have on you. Paying off your mortgage early will lower the total interest you pay and give you peace of mind, especially if you have children and a family depending on you. And once a mortgage is paid off, you now have extra cash on hand every single month. Personal finance is personal. You know yourself and your tolerance for risk. I quit my job to become a full-time YouTuber, so I'm used to taking on a bit of risk. And I'm independent, no family or kids counting on me. So for me, I'd rather invest my money for larger future returns. Even though the interest rate on my variable mortgage has more than quadrupled in the past 2 years. It's true, my brother and I bought a rental property together. Our mortgage started at 1.5% interest, and now with the latest hike, we're paying 6.2% in interest. No question, that hurts. But there are some tax benefits to holding a mortgage. So in the end, I'm only paying about 3.5% in interest. Let me explain. If you take on a loan and you use that money for business or investment purposes, then the interest you pay can be tax deductible. This is incredibly powerful. Don't underestimate it. Since I bought the house as a rental property, I'm running a business. So whatever interest I pay on that mortgage, I get to deduct from my taxable income. If I'm in the 43% tax bracket, I get to reduce my taxes by 43% of my business expenses. That includes mortgage interest. My mortgage charges me 6.2% interest, but it's a business expense, so I get to save 43% on that. In the end, my after-tax interest rate is only 3.53%. That's barely anything. I can easily beat 3.5% in the stock market, especially in a tax-free account like the TFSA. I get to use this tax benefit because I'm renting out the house. If I lived in it, then I'd have to pay the full 6.2% interest. In the United States, you can deduct mortgage interest on a principal residence, but not in Canada. But if you run a business from your home, then there are tax benefits to a mortgage, even if you live in it. Here's an example. If I run a home business and I have a designated office space, I can deduct a portion of my home expenses. If my office that I only use for work takes up 20% of my home by square footage, I can deduct 20% of my mortgage interest as a business expense. So just like my rental example, my effective interest rate will be lower after taxes. Check out my Canadian business guide, my videos with the purple thumbnails, to learn more tax saving benefits. If it's not a rental property and you don't run a business, then your options are limited. But there is one last way to save taxes on your mortgage. It's called the Smith maneuver. This is a pretty advanced technique. I'll be making a whole video about it. In fact, I'm making a whole series on real estate investing, so stay tuned for that. Here's the bottom line. If your investment return can beat the interest rate, then paying down your mortgage might not be the best call. You're better off investing that money instead, especially if your mortgage interest is tax deductible. But like anything with money, you don't have to choose one or the other. You can try a hybrid approach. Pay down a bit of your mortgage every month to guarantee those interest savings and invest the rest to enjoy future profits. It's your money and your choice. So thanks everyone, and I'll see you guys on the next episode of The Canadian in a T-shirt. Bye guys.